Hi everyone, thank you for watching my new video. I'm Chia, and this is a very simple introduction to financial accounting. The purpose is not to cover this in full-blown detail, but to have a very quick introduction on this topic. This will be useful for students who are doing this subject for the first time. Right? Hi, once again, I'm Chia, and you're watching this on my YouTube channel. Right? So let's begin. The scope of this video, basically a very short introduction to the world of accounting, and also to understand the different uses of accounting. Right. Moving on, we'll look at some simple application of the accounting equation, which is fundamental in the study of the subject of financial accounting. Next, we'll look briefly at the concept of the dual effect of accounting, which is really just a brief introduction to that. We'll close this with some very simple learning points. Okay, and let's begin. So, what is accounting? Lots of numbers, lots of jargons that don't make sense. Well, maybe I could put to you a very simple question. Let's say yourself you're a business person, right? And you have been asked about whether you might be interested to invest in a business. Right. Now, you might take the approach that you have this gut feel that the business might do well, or you might look at the business and observe the number of customers walking in and out, and then you conclude whether it's a worthwhile business to invest in. If not, what you could do is that you could go on to look at the accounts of the business, because by looking at the accounting records of the business, you have a better sense of how the business have done. How well has the business survived over the past 1 year, 2 years or so? You're able to better indicate or uncover how much borrowing does the business have, right? So that gives you plenty of information just from the accounting records, right? Especially, the history. So with accounting, you're able to go back to the history of the business years back, as long as as long as the history of the business, and you can actually uncover lots of interesting history, like how it has performed, and whether it has done well in terms of revenue, sales, and how has it managed its costs. Right? Accounting gives you all that data. Right? Imagine a pilot flying a plane would need to have some form of data to help him to make that decision on how high to fly and how to navigate the plane across the thunderstorm. So the same thing, accounting data acts as a form of radar, right? It gives decision makers, it gives people like yourself, who might be investors, who might be accountants, or whoever you are, it gives people like yourself a good sense of how the business is, right? And especially from the point of view of stock investors, because as a stock investor, as a business investor, you do not want to pay too much for what the business is really worth. At the same time, this also helps bankers. How would the banks know how much they can lend to the business? Well, then the bank has to look at the accounts and assess the revenues and costs of the business, and not forgetting, assess also how much debt has the business taken on. Right? Banks will be very interested to know whether they are comfortable with giving more lendings to the business. How about people such as employees? If employees need to bargain or to maybe fight for better work conditions, accounts also give them information as a good basis to bargain with business owners. Right? How about the government? How would the government know how much taxes should the business pay? Well, same thing. The government will go back to look at the accounting data of the business. So accounting is a base for many users to make their decisions, and their decisions vary a lot. Right? As you can see here, governments are interested to know how much taxes should business be paying, and investors are interested to know whether they are paying too much to invest in the business. Banks would like to know how much loans can they give. Employees would like to know how much more can they bargain for with the business. So accounting gives plenty of data, but accounting has very long history, and it is a subject that's widely practiced not just in businesses but also in charities and government agencies. So then just about everyone would use accounting data at some point in time or another, and this is where how you use accounting data really depends on your purpose for using this accounting data. And that's a very quick introduction. So now what we're going to do is that we're going to look at a very fundamental topic in accounting, that is the accounting equation. Now as a student in accounting, you are not really an accounting student until you have learned this topic of accounting equation. Let's have a look. Right. Before we start to look at the technical jargons which might be confusing to some. Okay, so a typical business might begin with certain amounts of cash and equipment and maybe some inventory. And in this example, I used Peter. Right, Peter is a business owner and he started ABC Groceries. So he started small with some cash of 100 and equipment worth 400. These were all provided by Peter. Right, Peter took whatever equipment he had from his house and then he put that into use at the business. Now, you have realized that, hey, that gives Peter a total of $500 worth of cash and equipment put into use in the business. We say that since this is from Peter, then therefore we say that the capital provided by Peter is therefore 500. So what did Peter provide? Peter provided assets. What are assets? Assets are basically anything that the business owns. So since these are provided by the business owner Peter, these are considered as owned by the business. Right? And what is owned by the business? Cash and equipment. So in this case, you realize that basically whatever capital that is put in by the owner, that should be equals to whatever assets that is now within the business control. In this case, it's cash and equipment. Let's look at something a bit more interesting. Now, businesses obviously are not that simple in real life. Businesses could have a lot more things, not just cash, equipment, but also inventory. Inventory would be any goods that are bought for purpose of resale. In this case, Peter provided all these items. So we go through the same question: how much did Peter invest in the business? So therefore, we say that these are assets provided by Peter, right? For use in the business, these are assets. So we have 100, 400, and 200. That gives you, or gives us, a total of 700. So how much did Peter put into business? 700. So we also can say that Peter has put in to the business $700 of capital. Right? So this $700 of capital is in the form of assets like cash, equipment, and inventory. Right? Realize something. Assets in total is equals to whatever capital there is in the business. Right? So now you have noticed that there are two terms that we have used, and one of them is assets. That's basically whatever that is owned by the business, provided by the owner. Capital is anything provided by the owner. It can be cash, it can be equipment, it can be anything. Let's look at example 3. Now this example is a lot more complicated now. Right now, ABC Groceries started with cash, equipment, inventory, and premises. These all were provided by Peter. But however, because there were a lot more things provided by Peter, then funding was somewhat short. He had to borrow 500 from the bank to cover some of the initial startup costs. Now, Peter had some assets that he had gotten to start the business: cash, equipment, inventory, premises. Now this gives us in total 1,700. Right? Now, but to obtain all these here that you see, not all these came from Peter. Part of it was borrowed from the bank, and therefore the business had some liabilities because they borrowed from the bank. Now the borrowing was 500, and now in this case Peter didn't provide all of the money to acquire all these assets. So how much would Peter have contributed? In this case, 1002. How do we know that it's 1002? Simple. Total assets available is 1007. So capital that was provided is only 1002. It wasn't enough, right? So the other part of the money that was used to purchase all this equipment and whatever it is came from borrowings from the bank, right? So the total of capital and liability gives us 1007. So this explains to us that all these assets, cash, equipment, inventory and premises, were acquired using capital and liabilities. Now have you realized that the assets, okay, that we have here, all these are actually acquired using capital and watch here plus liability, right? So from these three examples, you have realized that there is a very simple equation that we have verified and we have covered. That is the equation that says whatever assets in the business must be equals to whatever capital provided by the owner plus whatever money owed by the business. Liabilities refers to anything owed by the business. It can be for loan, it can be maybe goods that were unpaid. So this equation, assets equals to capital plus liability, is always true. Now this equation doesn't vary, right? You could adjust it, right, because it's a mathematical equation, but this equation, no matter what, is always true, right? So that's the very important rule. And using this, we'll cover another few more topics later on in another video on double entry. That's later on. Okay, so let me prove to you how we can use this as a mathematical equation. So assets equals to capital plus liability. So we can rearrange the equation like this. You can bring capital to the left hand side of the equation. So this gives you A minus C, which will give you liabilities. Or you can choose to otherwise bring the liabilities over to the left hand side. That gives you asset minus liability equals to capital. Right, so there are different ways to actually modify the accounting equation, right? And it's useful because by modifying the equation, it allows you to find or uncover different required information, such as how much capital is, how much liabilities are, how much assets there are, right? So that's the accounting equation. So let's move on, right? So the term that we have covered is assets. Assets are basically anything, keyword, owned by the business. Now these typically include cash, inventories, right? Then you have equipment, which you saw in the example, and so on, right? Liabilities. These are basically anything owed by the business. Now the common example would be like loan from bank, and maybe unpaid bills, right? For example, you have some bills that were due but these were not paid, so these become liabilities to the business. So these bills could be utility bills, it could be rentals that are not paid. So in short, so long as it's owing by the business, it's a liability. Capital basically is any, anything, can be money, can be equipment, whatever it is. And the important thing is that these are provided by the owner, right? So these are the three terms we have covered. So let's go on to more examples on the accounting equation. Now in this set of examples that we are going to be looking through is that we're going to prove that the equation, however it changes, the equation will always remain balanced. Now what do I mean by balance? Balance means that both sides of the accounting equation would be equal, right? However, the transaction is changed, however much figures that you use, the accounting equation would eventually be balanced on the left hand side and right hand side. which is this equation that we have went through earlier on. Okay, so that's the equation, which is asset equals to capital plus liabilities. Alright, so let's go through and prove that this equation is always balanced regardless of whatever transaction that occurs. So Peter, he had the following items on 1st January 2015. So there is cash and there is equipment. Now notice that I have indicated the date. Now it's very important that in the in any of these cases that you come across, you have to watch for the date. These do play a very important role in how you answer questions, right? So let's proceed. So early on, these were numbers that we used. So the accounting equation is actually asset equals to capital plus liability. We found that if these are the numbers that you have, the total asset should be 500 because it's 100 plus 400, that gives you 500. Total capital in the business must be 500. The only thing about this set of numbers is that from these numbers you can't find any liabilities. So the liabilities are actually 0. Right. So is the equation balanced on both sides? Yes, they are. Right. It's equal on both sides. Okay. Going on. Now, so we're going to make things a bit more interesting. Right. Now I have example 2. So example 2 says that Peter decided to purchase some inventories worth $30 and he paid all these by cash. How will the transaction affect the earlier accounting equation? The earlier accounting equation looked like this. Asset equals to capital plus liability. So earlier on we had 500 on the left, 500 under capital. There were no liabilities. So in this case, what happens if we choose to buy some stocks, inventories? So now inventories are assets. So when you purchase more inventories, asset value increases because there are more assets. Okay, let me write this clearly. More assets due to the purchase of the inventory. Now at the same time, he paid these by cash. What are cash? Cash happen to be assets. So at the same time, you find that assets decrease because he had to pay $30 to acquire the inventory. So in exchange for the money he paid, he got additional inventories. So there was a decrease in cash amounts. You find that 500 plus 30 minus 30 still gives you 500, and the capital amount is still 500. Liabilities remain 0. Now, is the equation still equal on both sides? You realize that yes, the equation is still balanced on both sides. Let's look at something a bit more different. What happens if we change the example? Let's say now there is now we are going to put the date here before we change the example. Let's put some numbers here. So this was what we realized on 2nd of January when he purchased the inventory. He purchased by cash. This was what we realized. The assets didn't change at all. Capital remained constant. Liabilities remain the same, 0. So this was what we realized just now. So in our following example, what we are going to do is that we are going to examine what happens if these goods that he is going to buy is on credit. Now the term on credit is a common term used in accounting. It simply means that the purchase is made earlier, right? Buy first and payment later. So this is what we mean by on credit. Okay? So on credit would make the way we study this transaction a bit different. Let's examine. So Peter purchased inventory, so there are more inventories, right? So this was what happened just now, right? The same, and this is the same as the earlier example, right? So there will be more inventories on the 3rd of January. So we find that there are more inventories, and these inventories are assets. Now going on. But these goods are not paid for. Payment later. paid later, it could be like month end, it could be another month, whatever it is. Which means that these goods are owing. You owe $40, or Peter owes $40 to suppliers. Right, no payment has been made. So this is quite different from the earlier example where he paid 30 to purchase stocks worth 30, right? Inventories worth $30. How do we record the 40 in our accounting equation in this analysis? Very simple. Where there is owing, this owing is classified as a liability. So what we do is that, okay, liabilities was 0 earlier on, but on the third, because he bought on credit, liabilities increased. Now observe, what are the total assets now? Total assets now is 540. Capital remain at 500. Liabilities increased by 40. Do you realize that the left hand side gives you 540? The left hand side also gives you 540. Does the equation balance? Yes, the equation balances. Interesting. Next, so, well, to rephrase, basically this was what we saw. There were additional stocks that were purchased by on credit, so that resulted in total assets of, how much is that? 540. Same here, 40, 40. So the both sides, the left side gave you 540, so does the right hand side, 540. So let's look at what happens if Peter decided to invest another 200 into the business. Will the equation still balance? It would. Let's see. Now what is 200 of cash? Now 200 of cash is an asset. Where is this money coming from? This money is coming from Peter. Now any money that comes from the owner and invested into the business is treated as capital. So you find that capital increases by 200. Does the equation still balance? Let's observe. The left hand side of the equation gives you 740. The right hand side likewise gives you 740. The equation balances, right? So this proves to you and myself, maybe, that all transactions, right, basically has two or more effects. At least the examples that I've shown you has at least two effects. Some transactions may have up to 3 effects. The sum of all effects on the left hand side is always equal to sum of all effects on the right hand side. So this rule is always true, which is where the accounting transaction, or rather the accounting equation, therefore, and I like to put this clearly, read the word always equal, or you can say that it always balances. It will never, you never have a situation where the left hand side is greater than the right. Both sides, left and right, must always be equal, and that is regardless of the transaction that is occurring. Not forgetting also that this also means that the transaction that is occurring has to be measurable in monetary terms, right? So like what you saw in my examples, measurable in monetary terms means that these has to be in dollars and cents, or whatever other currency that you might be studying this in. In our closure, so we have covered a quick introduction of financial accounting, especially on what are the uses and the purpose of accounting to different groups of people, such as the government, the investors, the banks, and so on. Right? We have studied the use of accounting equation, but that's a very brief examination of how the accounting equation is used, right, in analyzing transactions. Another important rule that we have examined very quickly was the dual effect of accounting, right? And that's the foundation of everything that you'll be learning in financial accounting, right? So I hope that has been informative, right? It's a brief introduction, but I hope that had been useful if you had been wondering like why do you have to learn this topic. Well, have fun, and I would be covering a new video on this topic soon. And I am Will Chia, and you have been watching this on my YouTube channel.